Well, let's review round 4. Competitive round 4. We're down to 4 rounds remaining. Gosh, just flies by. And again, I'll try to hurry through this a little bit now that it's later in the semester and you guys kind of understand a bit about what's going on. We see some, look at that. We have 3 teams with sales above 200,000, including the computer team, but student teams, Baldwin and Digby. So impressive, although Digby and Erie both, again, had, again for Erie, I don't think Digby had last time, but emergency loan. Profits, unfortunately, we had one student team only that was actually positive in terms of profits, and might be some distinct reasons for that, which might actually bode well for other teams on into the future, which I think may be an important consideration. So we look at contribution margins, which of course I always find enthralling. And Chester, typically student teams have been beating Chester, and Chester's kind of got the double good going here, right? They've got both the highest contribution margin and the lowest SG&A to sales, and while their sales weren't far off from, say, Digby and Baldwin, they're obviously realizing those sales far more efficiently, okay? And if I had to bet, you just bet that they're doing a better job of meeting the customer buying criteria. Okay, those are the main things. Spending a lot of money on marketing and whatnot is okay. That helps maybe, but if you're not meeting that customer buying criteria, Okay, every team but Andrews has actually sold some stock. That's kind of interesting. Cruise down. I'll let you guys figure out why. Debt, Andrews doesn't have much debt, neither does Ferris actually, or at least long-term debt. They're paying down some that was there and haven't issued any new, whereas the other teams all look like they've issued some new debt. I didn't see what ratings were. A for Ferris and an A for Andrews in terms of bond ratings. Everything else would be, in the real world, considered junk. I don't say that maliciously. That's just what they really call it in the real world if it's triple B or less. Inventories, we see inventories expanded. Look at that, with the exception of Erie. And if you remember right, though, Erie had huge inventory last time, especially in a couple of categories. They just had a lot of inventory left over. And so they obviously sold off some of that, made some headway at least. Plant improvements, look at that, some big dollars spent by Chester. And other teams. Erie looks like they probably sold off some capacity, maybe, trying to make the team a bit smaller. Ferris, not a lot going on there. Sales of common stock. So Chester sold a little bit more stock, and again, those are things that make me wonder. That is the computer team, but why, when you've got $45 million in cash, do you sell $7 million worth of stock, go through all the expense that's involved, and dilute your current shareholder base? If I were a shareholder of Chester, that would be somewhat upsetting. I've also borrowed a decent amount of money, both in the short term and the long term. Again, to have $45 million in cash sitting there, I don't know. Not the best cash management, but as a computer, what can we say? Retirement of current debt, we see some teams doing that a little bit. Cash, again, Digby and Erie had emergency loans, but otherwise, decent amount of cash. Andrews and Baldwin, that's pretty good cash management. If I finished around with that amount, I'd probably say that's pretty good, especially at this point in the game. You get a bunch more than that, like Chester, maybe even Ferris. You'd say, sitting on too much cash. Much less than that, you might be cutting it a little bit close, right? And so it's kind of like inventory. You want to have a little bit left over so you maximized your potential, but you don't want to have too much sitting there. Total assets, man, look at that. Chester's a huge team. Andrews is a much smaller team, really. Total assets. Look at that, 224 for Chester, and really about half size for Andrews. That's interesting. Okay, quite interesting in terms of size. And Digby and Baldwin, of course, sold quite a bit, and they're bigger teams as a result. Ferris being the smallest team, but they had by far the least sales too. And equity, we might see a fairly similar story, although we see Erie with a negative equity. Okay, so I don't think we have a Chapter 11 available for the game. Yeah, let's hope not. And besides that, I think they're going to get back on track. They made a lot of headway this round. Maybe they'll make some good decisions and move back into contention here next round. Total equity, though, you see Baldwin actually smaller than Andrews, even though Baldwin had a lot more sales. And look how small Digby is, actually. Okay, and while Digby didn't make any money this round, you remember they were negative in terms of income. Oops, that's down below, sorry. But just barely. And with that small, about half the size, not a little more than half the size of Team Andrews, but, that'll be really effective in terms of being able to generate a good ROE. And here we see, some interesting stuff. And again, I said this might have something to do with, the profitability or lack thereof for some companies. And what do I mean by that? Well, when I look at the income statement, and of course we got our sales that we saw up above, and our variable costs are just a function of our contribution margin, which we also saw up above. Depreciation, a function of how big, our plant capacity are. SG&A, R&D, promotions and sales and those types of things. And so we see here, 32 or almost $33 million. And a lot of that might have been in promotion, that drove Digby's sales, because Digby's had quite a bit better sales than Andrews if I'm comparing those two. But maybe R&D as well. Maybe Digby's positioning products or introducing new products, whatever the case may be. But next one down is the others, fees, write-offs, TQM, and bonuses. And usually the fees and the write-offs and the bonuses don't amount to too much. So I can look at this number and say, ooh, we had one team in particular, but two teams, Baldwin and Digby, that spent a decent amount of money on TQM. And we'll see that when we look down below. And we also see, once again, that Digby had a lot of interest expense. Chester and Baldwin as well. That has to go, that goes hand in hand with this low equity up here. Okay, so a lot of interest expense, probably a lot of debt, which leads to a lower equity. And if I go back up, I'll bet you we have a high leverage then, which I should have looked at. Voila, 3.7, which is a very high leverage number. Let's back down, take a look. Still quite a bit of capacity, but we're starting to use a little bit of it up. We've got 4 teams here that are at least using double shift to a certain extent. Chester, most obvious, but Digby, Andrews and Baldwin somewhat, and Erie and Ferris still lots of capacity there. Just glancing down, I always like to just kind of glance at inventory numbers and where we're sitting there, but I also glance over and I look at the automation. I like to see what my competitors are doing in terms of automation, in terms of lowering their costs through automation. So we see, we're seeing decent amounts of inventory on hand in the traditional low segments, low especially here for product EAT. And we'll ask the question there, why does product EAT have quite a bit? Again, it's in the low category. And the price there's $26, whereas Cedar's low product is $19. Okay, and I'm guessing that $26 is barely, within maybe that $5 range. Probably we'll see when we get down to the low, but it's probably barely within that $5 range that even makes it somewhat sellable. And so for them to really sell a lot of this product, it's going to take a much lower price, obviously. Not too bad there. Ferris had good inventory management, you might say. I'll cruise down through these. But again, look at the customer buying criteria. Those are extremely important if you want to see why teams are selling. Okay, it's generally related to that, and then secondarily, marketing and those types of things. Remember, we said Digby spent a lot of money on marketing, and you'll see that over here, right, in their promo and sales budgets, maybe compared to some of the other teams, and maybe why, in this case, they sold just a little bit more than Baker. Not many products really in the traditional segment. Age was, a few good factors and a few maybe not as good, but they also spend a decent amount of money on marketing. December customer survey, interesting. That means Baker's going to hit the ground running. Okay, probably because of the age, because I think the traditional 2 is the magic age, right? And so they're really close to that, so they'll probably hit the ground running. Their price is decent, et cetera, et cetera. In the low end, remember we talked about EAT, right? It sold a little, 298 units. But yeah, $26 when 23. So we're $3 over the high end expectations. Probably just not going to sell a lot more than that. Okay, when you're that far up in price, when you look at the leaders up here are Ebb, which was another one of their products, actually sold quite a bit better than I might have expected. It had a good age profile and whatnot compared to some of the other teams. So, yeah. But Edge, Echo, look at those prices and trying to, of course, these ones, I think EAT's the only other one. Ebb and EAT are the two that are actually selling mostly in the low. These ones are traditional products, Edge, Echo, and Egg. Go up here and see if they sold some up here. Yeah, Echo, Edge, and Egg. They sold reasonably well. So if you remember last year, they were completely out of whack on their pricing, and so they've kind of pulled that down into place, at least to a certain extent. And look at this. Okay, glanced at this when I was first kind of looking at it, and look at how much Andrews gave up. Andrews is well positioned. Looks like they got 2 or maybe 3 products. We'll see here in a minute in the high end. And so overall, their product mix is probably pretty good, and looks like their actual sales were about 24% of the marketplace, but it looks like they could have had 42, 41% of the marketplace. So they gave up a lot. They were only the third biggest seller, Adam, anyhow, 23% between their 2 products, but Adam was only the third biggest seller, but it sold out, as did Ace, even though those products were probably pretty well positioned, and obviously, again, they could have sold a lot more. Be interesting. What you want to do is look at the bottom, when we get down there and look at the actual numbers to see which one truly really got beat up. I'm guessing it's Ace. Ace probably could have sold a lot more. Ace was probably a brand new product though too. Sometimes that happens where you just can't. It's real popular, but you just can't make enough. Part of that is even if you had the capacity and you ordered it, if your revision date's in the middle of the year, you only get to make it from that revision date on. And so it can, even though you might have ordered more, that might be all you could make. Okay, and that can happen. It wouldn't surprise me that is what happened there. Performance, you guys can kind of look through those customer buying criteria and look at what products are doing well or not. I said Ace, could have had, look at there, in the high end, could have had 23.3% and only ended up with 6.4. So, gave up, whatever the heck that math is, 17% almost, not quite, 16.9%. And their other high-end product was Adam. Not so much there, 18.8 and 17. So it might have been that the reason they gave up a bunch there was just, again, didn't buy enough capacity. Let's go see what their capacity was. For Ace, high-end, 250 in capacity. They maybe tried to max that out with 500. But again, because the revision date was kind of middle of the year, they might not have gotten a full year's production out of it. Only partial. perceptual map. You see, you got your Andrews and Chester out here competing pretty solidly at the front end. Okay, Digby kind of, a little make me a little nervous there. I mean, they've got some products kind of positioned in these two in the middle, but they got these ones look like they're about ready to fall out, right? And keep in mind, they spend a lot of money on R&D or sales, marketing, those types of things, but not apparently to really keep those products very far forward. HR, I was seeing some, look at that, we're starting to see some really good productivity numbers that will have a big positive impact, okay? And certainly cost some money. Again, might have contributed to some teams doing not so well this round, but it may give them some favorable conditions going forward. And here we look at the TQM and Baldwin and Digby. Look at that. Andrew spent some money. They spent $2 million, but must not have paid attention. There's little pop-ups as you're investing money in these categories that kind of tell you what how much that might impact. Okay, and obviously they got no impact for that $2 million, whereas Baldwin and Digby, and I asked you a question about Digby and their investment and how, especially here, it increases their demand. Okay, but it's basically a cost recovery thing, and how soon they might recover this $20 million. But here, look at that, almost a 6% and over 7% reduction for material and labor, respectively, and reduction in R&D cycle time, which, remember I said that you got Baldwin going to fall out. As you're revising things, you can't revise them too aggressively, or the revision date gets out too far. But now with that reduction in cycle time, they'll be able to move those a little bit further along the line. Okay, so they might be able to bring some of those back up to be more competitive, whereas they wouldn't otherwise. The reduction in admin costs, you have to look at your own admin costs and see what they are, but they've got theirs just about in half, and then a demand increase of 7.69%, which, again, think back to the sales up there, okay? And the two teams that competed best with Chester in terms of overall sales were Baldwin and Digby, which had, respectively a 6.63 and a 7.69% increase in demand, okay, because of the money that they spend down here. That's, what's that? They were over about $200 million, so $14-15 million, okay, that those teams each probably picked up, okay, which obviously then came from someplace else. So be interesting to watch the payoff of that as we go forward. I think that's it kind of for the review. I haven't done the winter worksheet yet, so I'll do that and I'll send it out. You guys can look at it. I bet that since we only had one team that was actually profitable, of course I hope that doesn't screw up my scoring model, but that Andrews, I'm sure, was the victor for this particular round. So thanks, and we'll talk to you next week.